Two investments, both track the same index, both hold the same stocks, both charge less than 0.05% per year in fees. But one of them could quietly cost you thousands of dollars in unnecessary taxes, and the other one will not. Index funds and ETFs look almost identical on the surface. Most beginners assume they are interchangeable. They are not. Today, we are going to show you exactly how they differ, which one fits a freelancer situation better, and the specific accounts where each one belongs, so your money works as hard as possible from day one. Welcome to Freelancer Retirement Lab, where self-employed professionals get the data-driven financial education they need to build real wealth. If this is your first time here, subscribe now. We publish every Tuesday and Thursday, covering retirement, tax strategy, investing, and financial planning built specifically for the self-employed. Find out what they have in common. Before we get into the differences, let us establish the foundation. Because index funds and ETFs share four critically important traits that make both of them excellent choices for freelancers. First, they are both passive investments. Neither one tries to beat the market. Both track a market index, like the S&P 500, which covers the 500 largest companies in the United States, and simply mirror its performance. Second, they are both diversified. When you buy a single share of an S&P 500 ETF or invest in an S&P 500 index fund, you instantly own a tiny slice of 500 different companies across every major industry. One investment. Third, both have incredibly low fees. You can easily find funds with expense ratios under 0.05%. On a $10,000 balance, that comes to just $5 per year, compared to an average of 0.64% for actively managed mutual funds. Fourth, both outperform active management over time. Decades of data show that passively managed index funds and ETFs consistently beat the majority of actively managed funds over 10, 20, and 30-year periods. For a freelancer investing for retirement, this is the most important data point of all. So the question is not which one is better overall. The question is which one is better for your specific situation as a freelancer. And that answer depends on 5 key differences. Difference 1. How they are bought and sold. The primary difference between ETFs and index funds is how they are bought and sold. ETFs trade on an exchange just like stocks, and you buy or sell them through a broker. Index funds are bought directly from the fund manager. Here is what that means in practice. An ETF, exchange-traded fund, can be bought and sold at any moment during market hours. If the market opens at 9:30 a.m. and you want to buy at exactly 10:15 a.m., you can do that at the live market price. An index mutual fund can be bought and sold only at the end of the trading day at the fund's net asset value, its NAV, which is calculated after the market closes at 4 p.m. For a long-term retirement investor, which is exactly what most freelancers should be, this difference is almost completely irrelevant. Whether you buy at 10:15 a.m. or at 4 p.m. today will have zero measurable impact on your retirement balance in 25 years. The intraday trading feature of ETFs is valuable for active traders. For buy-and-hold retirement investors, it is a feature you will rarely, if ever, use. Verdict on this difference: slight edge to ETFs for flexibility, but practically irrelevant for long-term freelancer investors. Difference 2. Minimum investment. This is where the practical difference matters most for freelancers who are just getting started. The minimum initial investment for index funds can vary, but they often range from $1,000 to $3,000. Vanguard's popular VFIAX S&P 500 index fund, for example, requires a $3,000 minimum to open. ETFs are generally seen as having a lower entry price, since the minimum investment is typically the cost of a single share. And many major brokerages now offer fractional shares, meaning you can start investing in an ETF with as little as $1. For a freelancer in the early stages of building their investment portfolio, especially one managing variable income, the ETF's lower barrier to entry is a genuine practical advantage. You do not need $3,000 saved before you can start. You can invest $50 or $100 this month and add to it when you have more. Consistent small contributions beat waiting for a large lump sum every single time. Verdict: clear edge to ETFs for freelancers starting with smaller amounts. Difference 3. Fees and costs. Both index funds and ETFs have very low expense ratios, often identical for funds tracking the same index. For example, the Vanguard S&P 500 ETF, ticker VOO, has an expense ratio of 0.03%. The Vanguard S&P 500 Index Fund, VFIAX, also has an expense ratio of 0.04%. Essentially the same. But ETFs carry one additional cost that index funds do not: the bid-ask spread. The bid-ask spread is the gap between what buyers are willing to pay and what sellers are asking. For major, heavily traded ETFs like VOO or SPY, this spread is tiny, fractions of a cent. For smaller, niche ETFs in specific sectors or themes, the spread can be significantly wider. Most major brokerages now offer commission-free trading for both ETFs and index funds. So for popular broad market ETFs, the total cost difference between ETFs and index funds is negligible. Verdict: essentially equal for broad market funds. Watch bid-ask spreads on niche ETFs. Difference 4. Tax efficiency. This is the most important difference for freelancers who invest outside of tax-advantaged accounts, and it is the one most people do not understand. ETFs are more tax-efficient than index funds, thanks to the way they are structured. When you sell an ETF, you are typically selling it to another investor, and the cash comes directly from them. Capital gains taxes on that sale are yours, and yours alone to pay. Here is the problem with index funds. To get cash out of an index fund, you technically must redeem it from the fund manager, who then sells securities to generate the cash to pay you. When this sale is for a gain, the net gains are passed on to every investor with shares in the fund, meaning you could owe capital gains taxes without ever selling a single share. In other words, with an index fund held in a taxable brokerage account, another investor's decision to cash out can trigger a tax bill for you, even if you did absolutely nothing. This is why financial planners consistently recommend ETFs for taxable brokerage accounts and index funds for tax-advantaged retirement accounts. Here is the key rule for freelancers, and write this down. Inside your solo 401k, SEP IRA, or Roth IRA, where all growth is already tax-deferred or tax-free, the tax advantage of ETFs essentially disappears. In a tax-advantaged account, the tax differences between ETFs and index funds become irrelevant. Use whichever is simpler. Outside those accounts, in a regular taxable brokerage account, ETFs are the more tax-efficient choice. Verdict: ETFs win for taxable accounts. It is a tie inside retirement accounts. Difference 5. Automation and simplicity. Here is the final difference, and for many freelancers, it is the most practically important one. Index funds, particularly through platforms like Fidelity or Vanguard, allow you to set up automatic recurring investments. You link your bank account, choose an amount, choose a date, and every month the investment happens automatically without you touching it. This is called dollar-cost averaging, investing a fixed amount at regular intervals, regardless of market conditions. It is one of the most psychologically powerful investing strategies available because it removes emotion from the process entirely. ETFs do not have the same seamless automation at most brokerages. ETFs are generally better for frequent trading because you can buy and sell shares throughout the trading day. But that same flexibility that makes them great for active traders makes them slightly less frictionless for automated monthly contributions. Some brokerages like Fidelity and Schwab now offer automatic ETF investing, so this gap is closing. But if automation and simplicity are your priority, index funds still have the edge. For freelancers managing variable income, client deadlines, and all the demands of running a business, the investment that runs itself is often the investment that actually gets funded consistently. The index mutual fund remains the gold standard for investors who prioritize automation and psychological discipline. By removing the temptation to trade during market hours and simplifying the contribution process, index funds help investors stay the course through the inevitable cycles of the market. Verdict: index funds win for automation and psychological discipline. The Freelancer Decision Framework. Now let us put this all together into a clear decision framework specifically built for freelancers. Situation 1. You are just starting out and have less than $1,000 to invest right now. Start with ETFs. The low minimum investment, as little as $1 with fractional shares, means you can begin immediately. Pick a broad market ETF like VOO tracking the S&P 500, or VTI covering the total U.S. market. Open a Roth IRA and buy inside it. Situation 2. You have your emergency fund built and are ready to invest consistently every month. Use index funds inside your solo 401k or SEP IRA. Set up automatic monthly contributions. Choose a total market index fund with an expense ratio under 0.17%. Let it run on autopilot. Situation 3. You are in a higher income year and have already maxed your retirement accounts. You want to invest additional money in a taxable brokerage account. Use ETFs. The superior tax efficiency of ETFs in taxable accounts will save you money year over year compared to index funds. Situation 4. You want the simplest possible approach and do not want to think about this. Buy a target date fund inside your retirement account. A target date fund holds a mix of index funds and automatically adjusts its asset allocation as you approach retirement. This is the right answer for many freelancers who want to invest without spending mental energy on portfolio management. The 5 funds. Every freelancer should know. Here are 5 specific funds that come up repeatedly in freelancer financial planning. These are not personalized recommendations, but they represent the building blocks most long-term passive investors use. Fund 1. Vanguard S&P 500 ETF, ticker VOO. Expense ratio 0.03%. Tracks the 500 largest U.S. companies, one of the most widely held investments in the world. Fund 2. Vanguard Total Stock Market ETF, ticker VTI. Expense ratio 0.3%. Covers the entire U.S. stock market, including small, mid, and large cap companies. Broader diversification than the S&P 500. Fund 3. Vanguard Total International Stock ETF, ticker VXUS. Expense ratio 0.07%. Covers international stocks across developed and emerging markets. Pairs well with VTI for global diversification. Fund 4. Fidelity Zero Total Market Index Fund, ticker FZROX. Expense ratio 0.00%. Yes, zero. Available only at Fidelity. Tracks the total U.S. market with no annual fee whatsoever. Fund 5. Vanguard Target Retirement Funds. Series of funds named by target retirement year, e.g. Target Retirement 2945. Expense ratio approximately 0.08%. Automatically balances stocks and bonds and shifts to more conservative allocation as you approach retirement. The simplest complete investing solution available. The Compound Growth Reality Check. Here is why the choice between ETFs and index funds matters far less than the decision to actually start investing consistently. A freelancer who invests $500 per month, starting at age 30 in a low-cost S&P 500 ETF with an average 7% annual return, will have approximately $567,000 by age 55. Approximately $1.2 million by age 65. The same freelancer who spends 6 months researching the perfect fund and then invests $500 per month starting at age 30 and a half will have approximately $24,000 less at age 65, just from that 6-month delay. The difference between the best ETF and the best index fund tracking the same index is measured in fractions of a percent per year. The difference between starting now and starting 6 months from now is measured in tens of thousands of dollars. Both ETFs and index funds are excellent for compounding wealth. The key is consistency and staying invested. Pick one. Start. Keep going. So what are the common mistakes freelancers make? Let us cover the 4 investing mistakes that cost freelancers the most money. Mistake 1. Waiting for the perfect moment to invest. There is no perfect moment. Time in the market consistently beats timing the market. Every month you wait costs you compounding you can never recover. Mistake 2. Investing in a taxable account before maxing retirement accounts. Every dollar invested in a taxable brokerage account before your solo 401k or SEP IRA is full is a dollar paying unnecessary taxes on its growth. Fill the tax-advantaged buckets first. Mistake 3. Choosing actively managed funds over passive index funds or ETFs. The data from 2026 is consistent with every prior decade. The majority of actively managed funds underperform their benchmark index over 10 or more years. Higher fees, worse returns. Choose passive every time for long-term wealth building. Mistake 4. Checking your investment balance too frequently. Studies consistently show that investors who check their portfolios frequently make worse decisions than those who check quarterly or annually. Set up automation. Check in quarterly. Trust the process. Let's summarize your investing action plan. Here's exactly what to do after this video. Step 1. Open a brokerage account if you do not have one. For retirement investing, open a solo 401k, SEP IRA, or Roth IRA at Fidelity, Vanguard, or Schwab. All 3 offer commission-free trading and excellent index funds. Step 2. Choose your first fund. Starting out with under $1,000, buy VOO or VTI as a fractional share. Ready to automate. Choose a total market index fund or target date fund inside your retirement account. Step 3. Set up automatic monthly contributions. Choose a fixed date, the day after your most reliable client payment, and automate your contribution. This is the single most impactful investing decision you can make. Step 4. Forget about it. Check quarterly. Reinvest dividends automatically. Add more when income allows. Do not let short-term market movements change your long-term plan. Step 5. Once your retirement accounts are maxed, open a taxable brokerage account and use ETFs for their tax efficiency on any additional investing above the retirement account limits. The most important investing decision a freelancer can make is not choosing between an ETF and an index fund. It is deciding to start and then not stopping. Both vehicles are exceptional. Both are low-cost, diversified, and proven over decades. The right answer for most freelancers is to use both: ETFs and taxable accounts for tax efficiency, index funds and retirement accounts for automation and simplicity. Drop a comment below with where you are in your investing journey. Have you started yet? Are you in index funds, ETFs, or both? I read every comment and reply to as many as I can. Like this video if it gave you clarity, subscribe to Freelancer Retirement Lab, and check out our previous video on how much freelancers should save for retirement each month, linked above. See you at the next video.